This is going out there. It's Thursday, March 24th. I'm Frank Curzio. It's the Wall Street Unplugged podcast where I break down the headlines and tell you what's really moving these markets. A special Thursday for you. I like to bring interviews every now and then in. When we do them on Thursdays. But sometimes we like interviews and sometimes we just like to talk. So I'm going to bring in Daniel Creech 2 days in a row, buddy. It must mean that I really, really like you to bring in 2 days in a row, huh?
Or we couldn't get a guest scheduled. But we'll go with that one. No, it's great to be here as always. Love these segments. A lot of fun here.
No, it is pretty cool. And I wanted to bring you on because we've been having a lot of conversations too in terms of what's going on with the markets. And it just seems like something big happens every day during this volatile time, especially since November. And one of the things that's huge, that's really huge, is interest rates. So we're seeing a 10-year absolutely surge, right? 2.4%. When I say surge, 2.4% historically is not high, but it's very, very high compared to where it was just a few months ago. And that's pushing interest rates up incredibly higher. And one of the things that is up tremendously is the 30-year fixed for mortgages. And we're looking at it now closing in on 5%. Okay, it's 4.9 something when I'm looking right now, 4.9 closing in on 5%. Mortgage applications fell 8% last week. This is going to impact that. I mean, this was massive, very, very quick, right? Very, very quick to 5%. And the reason why, why we seen a surge over the past couple of days, and we really didn't see it right after the Fed meeting last week with Powell, is on Monday when he was speaking at whatever event, he was much, much more aggressive compared to what he was on Wednesday when he was testifying for the Congress. So, and to the point where I think we all knew, like, these rate hikes have to happen faster and they're going to be greater, right? 25 basis point hike is not going to do anything. And we have massive runaway inflation and we don't see it slowing anytime soon. A lot of the governors came out and said, nope, we got to go faster right after that. So he came out, I think it was on Monday, and said, we are going to go at a faster pace and it could be 50 basis point hikes going forward. But people, it's funny how when you look at the reaction where Goldman updated, they were surprised by this, right? They said, okay, now it's going to be the next two meetings are definitely going to be 50 basis point hikes. Now that's pricing in. But now you're seeing the rest of the market starting to price this in. And it's pricing in that we're not just going to get a few of these 50 basis points, they're going to go sharply higher, 5% mortgages. So crazy times, but it definitely impacts the markets.
It does. And it'll be, you were running some calculations earlier, just locking in, if you did say at the end of the year a few months ago, that payment per month is probably up at least a couple $100 right now, give or take. I mean, obviously that depends on what kind of loan you're doing and all that, but generally speaking.
Here it is, because I know you love numbers. And I'm going to say, because this is what consumers understand, right? Because if you understand this, if you're looking for a home or if you bought a home, right? So let's go through the numbers, right? And say if you're buying a home for $500,000, okay, which is, common these days with home prices through the roof. Maybe you get them a little bit lower in some other areas, but say $500,000. You put 20% down, so that's a $400,000 loan. In November, a few months ago, 4 months ago, rates were 3%. 4 months ago, 3%, right? And if you're looking at 3%, your payment each month would be $1,650. Okay, that's not including insurance or taxes. This is straight just for the loan, right? $1,650. 4 months later, at 5%. Nothing changed in your life, just that rate is 2% higher, and it sounds like, well, it's 2% higher, it's going to hurt. At 5% under those same terms of that loan, $400,000 loan, we're looking at payments of $500 more a month. So $6,000 a year in extra payments. That is absolutely massive. I mean, you could do the calculations. You can go even further. You could see, over the year, over the life of the loan, how much you're going to pay over that life of the loan is almost double, right? And just an interest we're talking about. So you're looking at this from a consumer point of view going, holy shit, how could I purchase a house when I wish I did it 4 months ago? So now you're going to wait, and you're going to wait thinking that rate's going to come down, but they're probably going to go higher. I mean, there's nothing signaling that rate's going to go lower. We still have supply chain bottlenecks everywhere. Oil prices just last week, fell below 100. Now they're at 111, 112, 113 now, right? So we'll talk about oil in a second, but you don't see anything that's going to happen that's going to ease inflation. We have a Fed that's just, again, I don't like to talk terrible about the Fed. They try to do a good job. Powell's trying to do a good job. I know it's natural to talk negative about the Fed. You can't say anything positive about it. but they've been really, really, really wrong. And they're trying to sugarcoat this. And I think people are starting to understand something that we've been saying for a while here is they don't have a choice. And when I see people on TV talking about the Fed saying, oh, you know what, they're not going to do that. They're going to go a lot easier. They don't have a choice. Okay, this is inflation. This isn't some bank that blew up that you could just take those assets and backstop them and throw them into JP Morgan like you did during a credit crisis and make those banks, all those rules in place so we don't have banks too big to fail. They're 4 or 5x bigger than they were back then, right? It's not that you can't throw money at it. You got to take money out of the system. You don't have a choice. You don't have a choice. So this is impacting consumers tremendously. From an investment standpoint, Daniel, you have to ask yourself, who is making the bulk of that money? Who is making the bulk of that money as interest rates go higher? Like that money that you're paying out of your pocket, who is making that money? And it's the banks. The banks are still down 20% off their highs. It's one of the greatest investments you can make. We just made our investment, our recommendation in Curzio Venture Opportunities, which is a bank. And people say, well, banks are boring and you get some 2-3% yield in a small cap bank or whatever. This bank has a ton. I won't give you the amount because I don't want people to search and try to find out. They have a ton of amount in
don't
deposits.
Do it. Don't give it to them.
No, ton in deposits. Ton of deposits. It's their main, and again, this is the last thing I say about, but most of exposure is in Florida and Texas, right? And those are the two biggest growth areas, huge population growth. Everybody's moving there. You're saving money on taxes. So even as that rate goes higher, if you're moving from place from California, New York, where you're paying massive taxes, that makes a lot of sense to go to these areas. And these bank companies, these bank stocks are now the new growth stocks. These are the new growth stocks. Now, technology, the bank stocks are not these boring little things. You are going to see earnings absolutely surge in the years ahead as they continue to raise rates because they barely generated any net interest income. And all of it was from fees. And, it's the banking fees you pay, the higher wire fees you pay. It's all fee. They feed a death bank. Fee. All fees. Now you're talking about interest rates going up. They're going to make the difference. And we're talking about a massive, massive difference. If you are a subscriber, frankly speaking, I'm going to break down some of the banks and what they're saying because I get quotes to all these banks that, were broken down by, something that, again, we pay a lot of money for a firm that does this. And you have to see what they're saying about it. And they're just pricing in, 3 hikes. If it goes up 3, if we have 3 hikes, which is, the 25 basis point hike, and then we got, a 50 base, they'll count as 3, right? So 1 hike is 25. That's what they're saying. So if it goes up, the amount of money that they break it down. I'm going to talk about this, and frankly speaking, I'm getting a lot of questions on it. I don't want to give away too much stuff for free. We give away a lot of picks and a lot of stuff for free, but we do have services here that people pay for. So I want to give the great stuff to them and the picks to them. Guys, put banks in your portfolio. You have to do it immediately. You're getting a 20% discount. I don't even know why they fell. They fell Russia, and they don't really have that much exposure to Russia. But man, these guys are going to make an absolute fortune for doing nothing, right? The profits are going to explode for these names, right? Just simply, they're not like looking to put money. They have to hire a bunch of people and to scale a business and put money in, and then once you scale, it keeps going and going and going. They're sitting there, and simply because a rate is going higher, a massive amount. We're talking hundreds of millions of dollars in free money is going to flow directly to their bottom lines over the next months and probably next 2 to 3 years as this cycle continues. And that's something that I don't hear too many people talk about. We'll buy the banks. They always have great play in higher interest rates, but when you see rates go high like this right away, this fast, that's unprecedented. It doesn't. You could say, well, we had a 5% mortgage rate a couple of years ago. It doesn't go from 3 to 5 in 4 months. I mean, it's a massive difference where these banks are going to blow out earnings. And they're not these boring little things and fees and, you buy them for dividends and stuff. No, these are going to see their growth stocks now. You're going to see earnings explode, especially in the quarters ahead, starting right now. And I would be buying, I'm going to say you could buy almost any bank. I'm not talking about one that's a garbage bank that's trading over the counter. And it's probably going to do very, very well for you over the next 12 months.
Well said. I like that sector. A couple of things to unpack there real quick. Mm-hmm. And it'd be great to get some feedback on this because $6,000 per year increased cost on a mortgage is a lot. Working a little bit backwards here, the only negative thing about the banks that I can tell and maybe why they got sold off along with the overall market, if you're worried about rising interest rates, you're worried about this hard landing versus soft landing, meaning they can guide the economy, the Fed, to raise interest rates, fight inflation, all without causing a recession or a big stock market crash. Mm-hmm. That's going to be very difficult. Mm-hmm. So the only negative point or the only counter argument to your thesis is, hey, recession comes, bank lending dries up, it's going to hurt the banks. However, when that is a risk, that's always a risk. But that's not enough to keep you from digging into this sector like you talked about on what they don't have to do a whole lot. It's like a scale. They don't have to do a whole lot to get a lot of increased profits because interest rates are moving without them. That's a big thing, and I like that. Frank at CurzioResearch.com, Daniel at CurzioResearch.com. Is $6,000 a year going to change your mind about an asset, a house? Historically, they're still dirt cheap. There's no way I would still be buying mortgages now if you can afford it on the cash flow point. The takeaway here is the balance. This is what is so great about markets, the balance here. So $6,000 a year or more in extra cost is a lot. That's going to make you make some changes and or figure that out, you and your partner, to talk. However, the same conditions that are driving those costs up, Frank, higher inflation, are going to actually be a tailwind for the actual asset we're talking about in housing. So as an investor, if you're buying a house because it's your forever house and you want to have a family and you want to be there until you die, so to speak, that's one thing. If you're buying it for a livable situation, an asset plus an investment, or just purely an investment, that's another take. And I just think that the inflationary aspect, if you're in housing or looking at housing, the odds are still in your favor, in my opinion, to buy that and pay the higher costs now because of the same tailwinds that are causing rising interest rates are going to be a boom for the price in that overall asset. And debt gives you a ton of optionality with refinancing, borrowing against, all that kind of stuff. And that's why I'm still bullish on this. So yeah, real estate and banks, absolutely.
Yeah, and to your point too, there's two things. People might say, well, during a recession, people are not going to borrow. So balance sheets are more stronger than they've ever been. Okay, it's not getting to the point where companies don't borrow. They need to borrow money. They're going to be borrowing at higher rates. We're not looking at 7-8% mortgages. We're not looking at less demand. There's still not enough supply in the market. I don't know. So I just talked to a real estate agent, a good friend of mine. He told me the supply on the market here and because he said, whenever you want to go golfing, Frank, let me know. And I said, I'm too busy. It's crazy. Trying to kids everywhere I'm working. He goes, I said, why? What's going on busy? He says, it's slow. I said, nobody's buying houses anymore? What's going on? He goes, no. He's like, there's zero inventory. He's like, it's a 0.8 month supply. He goes, it's usually on average 6-month supply. He said, on our whole entire island, there's 40 properties available and more than half of those are lots. That's all it is. He's like, there's no inventory. And you're still seeing that. So which means you're going to see more builds, more people taking out loans, even business loans and stuff like that. That's one thing. Another thing, you asked a question about the $6,000. So I think the bigger point is it's not if $6,000 is a lot of money to you, which it is, should be a lot of money to most people out there.
But it is the majority buyer.
It is, right? Yeah. So the majority buyer. But it's more to the point where that's $6,000 a year that's out of your pocket that you're not going to spend on something else, and it's not going to filter into the economy, right? So that's a vacation with your family right there where you can see airlines lose money, Expedia lose money, hotels lose money, and that's a big deal because you're taking money out of the economy, and that's going simply to a loan, and it's not like you're getting any productivity out of that. It's not like you're spending on an investment. It's a fee. It's a tax. That's what it is. It's an extra tax, right? So, and that's with mortgage rates of 6%. What happens if they go higher? So that's why it's a little scary. And I don't know if that's factored in. I figured we'd go to 5%. I didn't think we'd go to 5% in a couple of days. 4 months with 3 to 5% is insane. And 4 to 5%, we went really like a week, a little over a week. I think people are starting to realize, and the markets now are finally pricing in that, hey, you know what? Rates are going a lot higher. And like we said, Daniel, we said it's not that everything's going to sell off. It's going to impact a lot of companies, guys. Profits are way, way too high. If you're looking at earnings, they're way, way too high. They got to come down tremendously. You're going to see some of the bigger names report great profits, but you're going to see this quarter, I'm pretty sure, you're going to see them beat, and you usually see the beat and the raise. You're going to see the beat, just like we saw at Nike, a beat and reiterated their guidance. They didn't raise their guidance, which is interesting, saying, well, there's just too many unknowns, not just higher rates, what the consumer is going to do on those higher rates. Are they going to cut back, which you may see, which rates are going much, much higher. We'll see. We'll see how that turns out. But the next quarter's earnings are going to come out, even the next couple of weeks or whatever. When you're looking at earnings come out and what they say, there's no way that you're going to see very few companies really raising. And if they're raising and the stock goes higher, I'd probably use that as a short opportunity because it's impossible to predict what people are going to do. I think you're crazy if you're a CEO that really is, conservative, which you have to be when it comes to estimates. You don't want to get too crazy because your stock will fall 30% if you miss by a mile and you have super high estimates. And even the analysts can be blamed for that as well, but I just don't see it. They're going to have to either lower their estimates or maintain their estimates, and some of these things are still trading at high multiples. That's something I would worry about. I think, yeah. I mean, going into earnings season again, not everything's going to get hurt. We talk about commodities, we talk about Bitcoin, we talk about gold. Looks good. A lot of these things look good, but and oil. And Danny, you've been doing a lot of research on oil. We're always doing research on oil, but a couple of articles that you brought up were interesting. And listen, oil's all over the place, right? It was just fell below 100, went to 130, fell below 100. Now you're at 114 out of nowhere again. Again, pushing up inflation, pushing up rates. So oil. We have solutions, right? And we just won't act on them.
Absolutely. We have a crazy situation with oil because just like the banking sector and lending, your biggest fear is, hey, if there's a recession, demand's going to go down. You don't need all the oil, so the price is going to fall out of bed. The two macro tailwinds right now, obviously the Russian invasion of Ukraine, the war going on there, the sanctions that followed from governments all over the world and continue. I know they've announced more sanctions earlier this week. They've announced them over the last weeks. The simple thing is you don't have the technology or the resources to just replace oil, gas, coal, and switch to green energy like so many of the world leaders would like and are forcing companies to. Even without the Russia thing, oil prices were moving higher and sustainably higher because of ESG, environmental social governments, more politics, and more pushing from BlackRock that we've talked about in corporate America and the boards kind of taking over and influencing and pushing management away from fossil fuels. All of those were the thesis behind higher oil prices and the new normal. The war from Russia invading Ukraine have just pulled a little bit of that forward. However, what we don't know, Frank, is bearing a crazy recession where demand just falls through the floor. Who knows what's going to happen as this war plays out? Because if you damage, and as of now, I'm not trying to be a fearmonger, because as of, I think even earlier this week, gas was still flowing through Ukraine from Russia. So there hasn't been disruptions on the energy flow yet, other than sanctions, okay? Yet, they're really in between a rock and a hard place. So we were talking about how oil prices are going to be sustained higher for longer, and that's why you have to get exposure. Now, I don't know if you want to talk about the article do you want to talk about the Wall Street Journal article first, or do you want to talk about the capacity? Because there's rumors going around. Oilprice.com is a great website we've quoted before, and all around different messages boards that, hey, OPEC isn't increasing production like world leaders, us, UK, Boris Johnson, are asking, because maybe they don't have a lot of spare capacity or a lot of ability to increase that production as easily as what the market thinks. Bottom line is all this unknown just paves the way for much, much higher oil prices, and you could continue to gain exposure through Devon, Continental Resources, ExxonMobil, Viper Energy is a fun name that we used to kick around. Any pullbacks there, Frank, talk me out of being so bullish.
It's hard. It's hard to talk about being bullish. I mean, let's go over some numbers here, right? So just simple math. And again, I don't like to throw too many numbers with people like, oh, freaking data. Just tell me what to buy, and I get it, right? That's why people subscribe to newsletters. But we as a world, right, there's 100 million barrels, right, that we consume a day, around 100 million barrels, which is funny because I think there's only 600 million in our strategic reserve. So that's for the U.S., right? I mean, so it's just 6 days, right? No, our strategic for the world. So if you're looking in 2021, U.S. produced 12 million, Russia produced 11 million, and Saudis produced 10 million. You have Iraq, Canada, China, 4 million each out of that. So, and this is per day, and a bunch of others, right? So now you have the U.S., they consume a lot of this, right? 20 million barrels a day, right? So we produce 12, consume 20. Now, Russia is a wild card, and it's 11 million barrels, and say half of that comes offline, and that's why it's pushing oil prices sharply, sharply higher. You're talking about, the second, out of the top 3 producers in the world, that second one is really, at war, holding back, and, we're putting sanctions on them, and we want Europe to put sanctions on them. This way, nobody has electricity, and they freeze to death in Europe, right? So this is what we're telling Europe to do, which is funny. They just can't do that, right? They can't. I wish they could. They just can't. They're too reliant on Russia for energy. So what do we do about this problem? Say if it's 4, 5, 6 million barrels of oil a day. Well, it's very simple. We have that here in the U.S. We could drill right here in the U.S., right, and become the most powerful freaking nation by far, just blowing it. We already are, but much, much more, right? And you're looking at who consumes the most. It's, yes, the U.S. is on there, but China, India, Europe, these are places that don't produce that much oil, produce zero oil, right? So that's why India has to buy oil, and they're like, hey, if Russia's selling it for cheap, we're going to buy. They don't have a choice. I mean, we could shut off whatever we want. We're a rich nation, right? A lot of places can't shut off oil. You can't shut off oil. You need it. It's a necessity, right? As much as you think alternative energy, no, you need it. So, for Russia to be sitting on this oil, they're going to be able to sell it to anybody who wants to buy it, and everybody wants to buy it outside of the U.S. because they're going to be getting it for cheap, unless they want to destroy their entire economies, which we know every political system is based on how their economy's doing. If your economy's doing great, you're going to get voted in. So these people, do they want to say, oh, you know what? We're not going to buy oil from Russia anymore and destroy our economy, and then we're not going to have a job and we're not going to be in office anymore. No. So even the politics that involve are crazy. But you brought up something with Harold Hamm, which I think is incredible, where he has, I think it's an op-ed, is it, in the Wall Street Journal, talking about the federal permits. I know,
Yeah, I believe it was last week in the opinion section of the Journal. And he highlighted, and Howard Hamm is, I'm second guessing myself, it's Continental Resources, right?
Yep, Continental Resources.
Founded, and I think he's still chairman.
Wrote one of the biggest checks ever when he got divorced.
Yeah. Google that image. That is awesome. Or DuckDuckGo, because that is hilarious how you got to write all over the face of the check.
Hilarious
to
to everyone except for him.
Yeah, well, hey, when you got that kind of money, you can still laugh at it.
Yeah.
He has a great point. I encourage anybody to listen to it. The one thing that stood out to me was, of course, you're going to have the politics involved in everything. That's why you ought to pay attention to politics, because it literally affects everything that you do and spend money on in your lives. He pointed out, because the press secretary was talking about, and I always butcher her name, but she was talking about, hey, the Biden administration has highlighted several times that there's like 9,000 permits already available for oil companies to begin or start or continue drilling here in the U.S. So you have this tug of war where the oil companies are saying, hey, take the chains off of us, quit holding us back, quit making our lives harder, we'll produce more oil. Instead, you're calling on Middle East and other venues to, they're trying to do an Iran deal to get oil on supply, et cetera, when we have it right here at home. The White House is countering that with, you guys are just gouging prices. You're taking advantage of higher prices and just profiting and hurting consumers on it. So this 9,000, the White House has said, hey, there's 9,000 permits out there. In the Wall Street Journal, Mr. Hamm points out that the 9,000 they like to tout is really tied down with a lot of litigation. That's not just like saying, hey, there's literally 9,000 that can be used or start drilling right now. He says, according to their calculations, there's only about 1,500 permits, leases, et cetera, that are available. And a lot of those, he doesn't give more detail, but a lot of those are already producing. Who's telling the complete truth? Who knows? The point and takeaway here is you're always going to have these policies back and forth. Politics play an intricate role. The outcome of this situation is higher prices. As an individual, you need to understand, look at it like a game. It's March Madness. We're competing against one another. The policies that they're inflicting and forcing are going to make energy prices higher. As an individual investor, I look at the world as one of the only ways to fight back is to increase your net worth to try to be able to sustain a standard of living or increase it. So invest, listen to what they're telling you, and make money off of it. Gain exposure to oil and commodities, and keep the wolf away from the door a little bit longer. I don't want to sound so doom and gloom, but the odds are stacked against us individual investors, so, pay attention. Hell, it's bad. Even Axios, Frank, is reporting that Jamie Dimon from JP Morgan Chase, Jamie Dimon, is encouraging Biden to increase domestic oil and gas and wants to come up with a plan. Now, take this with a grain of salt because it was a closed-door meeting. It wasn't on Biden's schedule, blah, 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 blah. Anyway, shit's about to hit the fan with oil if Jamie Dimon is actually increasing or calling on that, if that's true.
All right, so a lot of things here, right? So one, it's important to realize that we're going into an election year, which is insane when you think about our national security. But that's the most important thing for our politicians, is getting reelected. You're looking at the Biden camp was promised less fossil fuels for a massive amount of votes and got a lot of money for it, right? Just like anyone will get money, any president will get money for what they promise, where you got to follow through. So, by him coming out and saying that there's 9,000 permits available, it sounds great for conservatives, pro-oil crowd, right? So you please them. This way you're like, well, I care about national security. But when you look at the underlying thing, and this is fact what Howard Hamm is saying here, right? This is a person that's in the industry, right? He's writing an op-ed where you just have, it stands close to the 1,500 that are ready for production, and many of these are already drilling. And he says no leases have been issued for federal land since 2020. Okay, that's very easy to find, right? So that's very easy to find. So the fact that we're not opening this up is crazy. And, you could say, well, Harold Hamm is talking his book, right? And you're right. And the oil guy is probably going to make more money on this, and that's fine. However, how about we open it up and we take a larger amount of those profits generated specifically on those leases and start funneling them to alternative energy things like solar, like wind, whatever, electricity, right? Open up more plants for EV vehicles. Have oil companies invest directly in this or use this as their carbon offsets to lower their carbon emissions. Doesn't that make sense? That pleases everybody, right? That pleases everybody. But we have the ability to become extremely powerful, sitting on massive oil reserves. Oil prices are through the roof. They're killing the consumer right now. I would think Biden has no choice to do this and make sense, and why you're not doing this and asking other nations that hate us, Iraq, whether it's Venezuela. I mean, can you guys produce a little more oil? Well, are you crazy? I mean, you're going to strengthen their economies when we're sitting on this right here where we could drill it and we have the best technology in the world that apparently a lot of people just can't mimic or use when it comes to fracking and hydraulic. This is the time. This is national security. This isn't about whatever. But Harold Hamm, even if he's talking his book, that's fine, because even if you're an environmentalist, left or whatever, I mean, someone who actually looks at numbers, which is probably like 2% of people, right? Doesn't matter the numbers or anything, right? They're always going to ask for more. This is a great solution for you. Solar, electric, wind, alternative energy, this is going to get developed much, much faster since you're going to have a ton of this money floating into this. It makes sense on every single level except on the political level, because if you do this, you're going to get attacked by the left. You're going to lose lots of votes going into here. And right now it looks like they're going to get buried, the Democrats, in the midterms. And they're just pushing this off. Watch what you see. No matter what happens. No one can predict what's going to happen in November. If you predicted today, it'll be a blowout. But who knows what's going to happen by November? Who knows, right? No matter who's in office, you're going to see this open up. You're going to see this open up. They're going to open up because now they don't have to worry for another couple of years. So they're going to be like, okay, if you see in this war, hopefully it's not as bad as it is now, and it doesn't exist, and whatever, there's ceasefire or some kind of peace agreement, everything's better. I'm hoping that happens tomorrow. But if it doesn't, heading into that, you're going to see once the election is done, now you're going to see this, which is insane to me. Which is fucking insane. Like, why wouldn't we be doing this now? Why? This is national security. This isn't about politics. We have oil. We could produce it. It's going to make us incredibly powerful. Everybody's in dire need of it. You're hurting us, right? You're killing the consumers. You're killing people who pay their bills, where the energy prices are through the roof. You're looking at, it's just, now you're seeing interest rates go up tremendously because this is causing even more inflation. Are you just going to sit back and do nothing? Because we have a solution. This isn't something we don't have a solution to. This is a viable solution that you could check the box for everybody. If everybody should be on board with something like this. If you're environmentalists, take that money, take some of that and throw it into, again, offset, carbon credits, whatever. Oil companies have to do this anyway. It makes no sense why we're not doing this, other than the fact that our politicians are going to go back on their word when they promise, less fossil fuels. But times are different. This is national security now. This is a very, very big deal. India is in dire need of oil. Europe's in dire need of oil. They're in dire need of this stuff. And Russia is cutting back, and now we're seeing how powerful they are. They really are that powerful. So it's sad about the situation. I don't know if anything's going to be done by it, but it's probably going to lead to even higher oil prices, like you said.
Of course.
You want to look at politics, and this is an investment podcast. How do you make money off it? You could scream from the top of the mountain, hold up signs, less fossil fuels, or, open up the drilling, whatever. Bottom line is, we're not going to see this happen right away. We're not. They're not going to open up more federal lands so we could, drill and with permits and stuff like that. You're not going to see that, and it's going to result in higher oil prices as long as this war is taking place. So you're going to see, there's still an opportunity to really invest in oil and make some money here.
Absolutely. Two quick things to wrap this up. You had me. You had me, Frank. I was excited. I thought you were taking me down. You kept saying, take the money. I thought you were going Steve Miller Band on me. Take the money and run. I thought you were going to work that in there somewhere. I like the idea, though, to try to please everybody. As investors, all you need to look for, here's the easiest thing to know, that higher prices are going to continue in oil and commodities. We don't have to get into it now, Frank, but over the next couple of weeks we will, because these guys are going to come up with it because they don't know what they're doing, the powers that be. Keep looking for headlines about stimulus checks. We've already seen rumors about the gas tax being cut. Over in the Europe and UK, they're doing some things about that. As long as these politicians and the powers that be are going to fix the problem by giving you a break here or there, or trying to give you stimulus checks, that proves that they're not going to focus on the core, and you just need to ignore that, brace for higher prices, and invest accordingly.
Yeah, so we're at the 30-minute mark. I wanted to get into one more topic. Maybe we got a minute or two, even though it's probably a 5-minute topic. But the Icahn and raises off for Southwest Gas, and being an activist investor. I know you've been up on that. You wanted to talk a lot about that. So I don't know if you want to just really dig in, since we are running a little bit over 30-minute mark here.
No, I'll keep it.
We want to talk about.
I appreciate that. I'll keep this real short, because, and we can talk about it in the future. Icahn's not going anywhere with Southwest Gas. That's a utility. The big takeaway here is I'm a huge fan of Icahn. He's had a great career, a very long career. He's had huge successes. He's had some failures like everybody. But what I really back him for and enjoy and want to listen to him all the time is because, Frank, we live in a world where everybody's woke and, cancel culture and all this. You want to clean up everything. That's what he is doing. And I know people are going to take easy shots at me, Daniel at CurzioResearch.com, because I'm defending a billionaire hedge fund titan. He genuinely cares about board and results. So if you read, and it's free, Google or DuckDuckGo, Carl Icahn increases. So he's trying to battle the board, get some board seats, shape this company, in particular Southwest Gas. The big takeaway here is he wants accountability on board members. He's not anti-making money, of course. And Frank, I think you would agree, it doesn't matter if Tim Cook is making $1 billion a year if you're an Apple shareholder, as long as Apple is performing and the stock is performing and everybody makes money. Yeah. That's what capitalism is. That's great. What he's calling out, and he lists, and you can look at his increased offer for Southwest, but he lists a ton of data points and says, hey, here's why I don't like this management team. They're not keeping their keep. They don't earn their keep. You ought to get rid of them. And he's taking it right to the shareholders. I like that. From a bigger picture, to wrap up, as an individual investor, pay attention to presentations, pay attention to conference call transcripts, and look at your management team and figure out, hey, do I like what they're saying? Do I think they're a carnival barker, like we joked yesterday? Do I think that they are passionate? Do they have skin in the game? Focus on management, because there's no better time to focus on management when you have a high inflationary environment and it's not just as easy to make money as it's been over the last 10 years.
Yeah, and this is activist investing, which is good for all the shareholders, right? Because you're going in, you want to have that management team accountable. You're saying, listen, you're not doing this stuff. And a lot of times when you have activists come in, the management team will meet with that activist, and then they'll go over some of those initiatives and say, okay, we get it. We'll meet you here. And that works. Because usually with activists, in order to be an activist, you have to be a big shareholder. So they're taking a big stake. And that's when they come out with these letters and say, hey, we got a big stake. And they try to convince the vote. A lot of times, you're not going to get the votes because they'll put in poison pills or the restructure like they did with Under Armour. So you're getting most of the votes, right? So it's very hard unless you're ExxonMobil, where there's really little insider ownership. And that's why, a small engine, whatever company has a tiny itsy bitsy position, and it was able to convince the Fidelities of the world and the BlackRocks that, these guys need to be more environmental friendly. And, they all voted to have people on that board. A lot of times it doesn't happen, and the board controls it, and they do whatever is in their best interest, and they make a fortune. While shareholders don't, they could dilute the stock incredibly, just to raise more money to put into other initiatives, which is going to grow revenue, and then they can pay themselves more. But when you're diluting shareholders, your stock's maybe not going to go up that high, right? There's just more shares outstanding. So holding them accountable is always a great thing, especially if you're a shareholder. There's no downside, right? Because usually all right, we want to buy this thing because you guys suck, and there's a big fight going on. Everything is, both of them are fighting because they believe the stock price should go higher, and usually it goes higher. So it's usually good. It's a positive for shareholders, most of the time, but the outcome is going to determine, where we're going to go. If Icahn is able to take this company over, they're able to make some board seats and changes and stuff, and really focus on those growth initiatives. But it's usually a good sign. And yeah, it's a good thing. You could argue and bust balls like, well, this is a billionaire just talking. Look, it's a billion. But, he usually, when they're activist investors, they're taking 3-4% stake in the company. The rest is owned by whoever. It's going to benefit all those people by them shouting at the rooftops and yelling at everybody, telling how bad management is. And then when they highlight how bad management is and hold them accountable, those guys need to change. So they're going to get better, even if it doesn't result in those changes. Because, Icahn calling them out, but it's usually a positive all around. I don't see too much of a negative, but it's usually good for shareholders. So, yeah.
Yeah, you got to have somebody that's willing to point out bad results, accountability. There's not to say anything personally bad about them, but if they're not doing their job, it's just good. We ought to have accountability in politics, term limits, different things. Corporate America is no different. We're not biased against that just because we're stock guys. So that's great.
No, that's cool. All right, guys. So thanks so much for joining us today. That's it for us. Questions, comments, Daniel gives his email address out. We give him FredCurzioResearch.com. So any questions, comments, we want to hear from you, especially from the $6,000 thing. I'm interested to see, people come in and say, how much money is that to you? Is that a big deal? Does it result in you cutting back spending? I'd love to hear things like that. I mean, with data driven, so, if the story changes, something changes, you're able to flip. It's not like, you just pound the table and you're stubborn, because I've been stubborn on things before and I've gotten wrecked. So feel free to email us, right? That's what this is. It's a massive, massive network of people. I've been doing this for 14 years. And because of you, it gives us an amazing pulse on what is going on out there in terms of interest rates, in terms of COVID. It's not like we're reading certain websites. When you're getting real-time data from you, that's how big the network is. And I don't care if you're a college student or you're a doctor. I don't care what it is. The information that you provide is real-time. And when you combine that times hundreds of thousands of people and over 100 countries that this goes to, it gives us a huge advantage to be able to predict things, to be able to see things, and actually recommend stocks based on the things that we're seeing out there from so many of you. So please, we encourage you to email in. That's why this podcast is so powerful for me. It's people say, you're doing a free podcast. This is why. I mean, it gives you incredible leverage to really what's going on in real time, because so much of this data is reported 3 months later, 6 months later. Knowing what's going on out there is from you guys, and I appreciate it. I just want to say thank you to emails. Once again, thank you to Daniel. And if you're a subscriber to any of our products at all, no matter what the price is, even if it's very, very low price, $1 stock club, $4 a month, you'll be hearing me tomorrow, frankly speaking. I'll see you then. Take care.